In today's video, you will learn the 7 beginner-friendly stock investment strategies. Investing is a reliable way to increase your wealth while still earning. Directing your funds into avenues like the stock market can grow your wealth over time. This is simply because stocks have a track record of providing higher returns than other assets. So, if you're intrigued by investing in stocks, today's video will guide you on how to kickstart your journey. When you venture into stock investment, there isn't a single path. It all boils down to your goals and how hands-on you want to be with your portfolio. For starters, one route is purchasing individual stocks. If you enjoy researching markets and companies, this method could suit you. Although certain company shares seem pricey, fractional shares are an option for beginners with limited funds. Investing in stock ETFs is another possibility. These funds gather various individual stocks to mirror an underlying index. Opting for an ETF means investing in multiple companies within a sector or a stock index, like the S&P 500. ETFs trade similarly to stocks but offer broader diversification than owning an individual stock. The other way to invest is through stock mutual funds. Although similar to ETFs, they differ notably, especially in actively managed funds where managers handpick stocks to surpass a benchmark index. Profits from these investments come from dividends, interest, and capital gains. The key is to find the right mix of individual stocks, mutual funds, and ETFs. However, before you even get to this point of your investment journey, it's crucial for you to first, number 1, determine your investment goals. Before you think of investing, defining your investment goals is essential. Are you aiming for long-term growth or seeking immediate income from your portfolio? Knowing what you want will narrow your investment options and simplify your decision-making process. Consider what you aim to achieve with the money you're investing. For instance, if you're starting your career, your goal might be to boost your account balance. However, if you're more established, your goals include generating income, protecting your wealth, or fulfilling specific financial milestones like buying a home or funding retirement. Knowing these goals and their timeframes will help gauge the risk you can handle and which investment account should be a priority. And remember, goals evolve, so regularly define and reassess them to stay on track. When opening a brokerage account, brokers like Charles Schwab or Fidelity will inquire about your investment goals and risk tolerance, which brings us to the next point. Number 2, assess your risk tolerance. Before investing, it's crucial to consider how comfortable you are with the possibility of losing money. Consider the level of risk you're comfortable taking with different kinds of investments, especially stocks, which come with varying degrees of risk. One way to do this is through short surveys called risk tolerance questionnaires that help assess your comfort level with potential losses based on your responses. Once you know where you stand, you can choose stocks that align with your risk comfort. After this evaluation, it's time to, number 3, choose your investment strategy. When considering your investment approach, consider the kind of investor you aim to be. Remember, there's no universal method for investing. It all ties back to your risk tolerance, capacity, goals, and time horizon. Some strategies may require a more aggressive approach, so choosing what suits you best is advisable. For instance, you can buy stocks independently through an online brokerage or seek assistance from a financial advisor or a robo-advisor. The best choice depends on how involved you want to be in managing your investments. If you're comfortable with investment basics, an online brokerage lets you select and purchase stocks directly. However, hiring a financial advisor is an option if you prefer guidance and personalized assistance. They help define your goals and handle investment management, including stock purchases, but they come with fees. Annual, per trade, or a percentage of managed assets. On the other hand, robo-advisors offer an affordable way to invest in stocks by managing ETF portfolios, but they lack direct human guidance typically found with financial advisors. Some blue-chip companies offer direct stock purchase plans for those interested in specific stocks. While they often provide commission-free trades, watch out for additional fees while selling or transferring shares. Remember, regardless of your chosen investment method, there are likely fees for buying, selling, or managing stocks. Pay attention to these fees and don't hesitate to inquire about them with customer service representatives for clarity. Once you've figured out your investment preferences, apply this understanding to pinpoint the number 4, accounts to invest in. When considering where to invest in stocks, explore the range of account options available, recognizing that multiple accounts can collaborate to serve a single goal. One option is a workplace retirement plan like a 401k, which allows investing in mutual funds and target date funds, sometimes even the company's stock. Often matched by employers, contributions are deducted automatically, growing tax-deferred and offering tax-deductible contributions. This method encourages consistent investing habits with minimal effort. Another option is a taxable investment account, which differs from retirement accounts and has no contribution limits. However, gains from stock investments are considered regular income, lacking special tax treatment. Education savings plans are available for those saving for education, typically investing in stocks through mutual funds or target date portfolios. Depending on your preferred level of involvement in stock investing, you can set up accounts through an online broker, financial advisor, at a bank, or through employer-sponsored plans. Once you've selected your preferred investment accounts for buying stocks, the next step is funding them. Setting up a monthly recurring deposit can be a strategic approach if you're using a retirement account such as an IRA. For instance, if the 2023 contribution limit for an IRA is $6,500 for individuals below 50 or $7,500 for those age 50 or above, you might set a monthly deposit of $550 to reach that maximum limit if your goal is to maximize your yearly contribution. When buying stocks through an employer-sponsored retirement plan such as a 401k, specify the percentage of your salary or a fixed dollar amount to be deducted from each paycheck. With other investment accounts, establish your investment goals clearly, then decide how much of your monthly budget you want to allocate for investing in stocks. You can manually transfer funds into your account as needed or establish recurring deposits to ensure your stock investment aligns consistently with your financial goals. As you set your investment budget and fund your account, consider these factors. Number 5, commissions and fees. Brokers usually earn through customer fees. Trading stocks usually incurs a commission ranging from $2 to $10 per trade. Limiting the number of trades can help reduce fees, especially as they can significantly impact your portfolio's returns. While some brokers offer zero trade commissions, they compensate with other fees, which might affect your overall investment amount. For instance, you decide to invest $1,000 by buying one share of stock from 5 different companies. If there's a $10 transaction fee per trade, you'll face $50 in total trading costs, 5% of your initial $1,000 investment. If you were to sell these stocks later, the total cost for both buying and selling would reach $100, equivalent to 10% of your initial $1,000 deposit. These costs can significantly reduce your account balance before your investments generate positive returns. When purchasing stock mutual funds, pay attention to the load on the shares. These funds often come with fees like the management expense ratio, ranging from 0.05% to 2% annually. Additionally, some mutual funds impose upfront or back-end sales charges upon buying or selling shares. However, not all funds have these loads, so checking for such fees beforehand helps avoid surprises. For those new to investing, mutual fund fees might be more attractive than the charges involved when buying individual stocks. Also, starting with a mutual fund often demands a smaller initial investment than you'd typically spend on individual stocks. So, do your research and choose what works for you. Number 6, start investing in stocks. Once you've completed your research and selected stocks aligned with your investment preferences, it's time to start investing. If you've opted for a robo-advisor, the system will invest your chosen amount into a pre-planned portfolio that matches your goals. With a financial advisor, they'll purchase stocks or funds after discussing your preferences. Once your order is successfully processed, the securities will be reflected in your account, and you'll start enjoying the stock market rewards. Of course, you'll have to expect dividends and potential losses as the economy fluctuates, but in the long term, your profits will accumulate. Consider joining a dividend reinvestment plan as you make your initial stock purchases. These plans utilize dividends from individual stocks, mutual funds, or ETFs to automatically purchase more shares of these assets. You may end up owning fractional shares, but that will keep more of your money active in investments rather than sitting idle in cash. Lastly, set up a portfolio review schedule. Once you've begun accumulating a stock portfolio, setting a schedule for monitoring and adjusting your investments if necessary is crucial. Rebalancing ensures your portfolio maintains a suitable mix of stocks aligned with your risk tolerance and financial objectives. Fluctuations in the market can disrupt this balance, making regular check-ins essential for making gradual adjustments to maintain portfolio stability. There's no need to check your portfolio daily. A monthly or quarterly review works well. When evaluating your portfolio, remember the aim is to buy stocks at low points and sell at higher values. As a new investor, it's possible to start investing in stocks with a modest amount of money. However, remember that all investments carry inherent risks, and there's no guarantee that your investment will appreciate over time. That's why it's essential to understand how to manage these risks effectively to reach your financial objectives, whether they're short or long-term. To navigate this, conduct thorough research to define your investment goals, assess your risk tolerance, and understand the expenses associated with investing in stocks and mutual funds. Additionally, research different brokers to understand their specific requirements and determine which aligns best with your needs. By doing so, you'll be better equipped to capitalize on the significant potential stocks offer for long-term financial growth. That brings us to the end. Thanks for watching. Please remember to share your thoughts down in the comment section below.